It off. All right. Good evening, everyone. Thanks for being here for the first time homebuyer webinar series presented by the Future Homeowner Plan. I'm your host. My name is Ralph Richardson. And tonight, our topic is going to be homebuyer grants up to $50,000 for first-time homebuyers in California. And our presenter for tonight is going to be Roxana Vazquez. She's a home loan advisor with Golden One Credit Union. And we are very excited to have her here this evening. I'm going to give her a little bit more of an introduction a little later on, but we're very excited to have Roxana here with us this evening to talk to us about grant programs that are available for first-time homebuyers.
Thank you, Ralph.
You're welcome. So before we get started, I want to give you just a little bit of overview about the Future Homeowner Plan, who we are, what it's about, and just a quick story to start this off. When I purchased my first home, I completed the process. I was very excited to be a new homeowner, but at the end of the process, I felt like I had been rushed through the process and really didn't understand everything that had happened along the way. And this is very often the story you hear by first-time home buyers who have gone through the process, but they feel like they didn't really understand some of the decisions that they were making during the process. So I thought, I became a realtor 8 years ago, what could I do to provide first-time home buyers an experience where they could really understand what the process of home buying looked like and how could I get them up to speed as fast as possible. So we developed a program called the Future Homeowner Plan, and we've been offering this program now for 6 years. And what it really is, it's a roadmap to buying your first home. It's a free app for first-time home buyers who are planning ahead for home ownership. And this is a great program, even before you have a conversation with a lender, to really get you up to speed about what to expect during the process. So our program breaks up into 3 phases: plan it, find it, and own it. And here in the planning phase, this is the phase where we really help you to understand everything you need to know before you get pre-approved for a mortgage. All right, we go over monthly payment, credit score, debt to income, down payment, closing costs, and we look at some of your mortgage options. And really, we're just educating you with some of the terminologies and things that you'll need to know so that when you get on the phone and you talk with your lender, it's a really, you come from an educated situation where you have an idea of what they're expecting and you're ready to communicate what it is that they're looking for. All right, and then the next phase is the find it phase. This is where we get out and start looking for homes. We build your wish list. We also make offers. So this is where you can learn a little bit about the home buying process, okay? And then finally, the own it phase. This simply is, what does the escrow process look like? What are contingencies and everything that happens during the escrow process, like inspections? We go over all of that with you in advance before those things happen. And this is one of the features that we're still building in our app, and it's coming soon. All right. But those are the 3 things we have to offer in the Future Homeowner Plan. We also have a few other cool features like Clarity. She's our AI coach. So she's available 24/7. And then you also can access your, real life coach, such as myself. If you want to have a one-tap access to your coach, be able to send text messages, you can also do that right here in the Future Homeowner Plan. We have a couple of other cool features like a mortgage calculator to help you figure out how much home can you buy depending on what your monthly payment is. We also have a debt to income ratio calculator. I find most of my clients that I've worked with really need some help with this one. To get them up to speed. But we have lots of great features here in the Future Homeowner Plan for first-time home buyers. And we hope you take a moment go to our website at thefuturehomeownerplan.com to check it out. Okay. So without any further ado, let's turn it over to Roxana. I want to just, really say really quickly about Roxana. I've had the opportunity to work with her for, I think, 7 or 8 years now. It's been a long
Since
time.
COVID. Yeah.
Since COVID. And
Yes.
she has been fantastic to work with. She has always found a way to help my clients with very, I'd say, unique programs that sometimes I couldn't find anywhere else. And so I'm excited to have her here tonight to talk to you because she is also a specialist in first-time homebuyer programs and down payment assistance programs. And the last thing I will say is she's very patient. She is excited to work with first-time home buyers. And so I'm very excited that she's here to participate in our presentation tonight. So Roxana, thank you for being here. And I will now turn it over to you.
Thank you so much for having me, Ralph. And thank you to our clients that have joined us. We appreciate your time. And let me tell you a little bit about myself. First and foremost, I want to let you know that I'm fully licensed. My license number is displayed in there, but just for the record, it is 490627. I work for Golden One as a home loan advisor. I've been doing mortgages for over 20 years, and I pretty much kind of know about a lot of programs. And the reason why I work for Golden One is because of the amazing programs and rates that they have. And then we want to share this information to clients and people out there because we know that a lot of times what we hear, and also based on reports, it looks like the number one reason why sometimes people hold in buying or purchasing a home is because of the down payment. So what we're going to cover today, we're going to emphasize in 3 programs that can you hear or talk? No, we cannot hear the baby screaming. We cannot. I think Ralph has everyone else on mute except me. But thank you for sharing that. Yes, so we're going to emphasize today in pretty much down payment assistance, grants, and loans. It is not the only way to purchase a home, but that's going to be the emphasis today. We also want to make sure that if you have any questions, you can put them in the chat. We will try to answer them as we move along, or we can always answer all the questions at the end. We're going to have Q&A. And then again, I want to thank Ralph for putting this together. He is an amazing realtor. He has spent hours and time in educating his buyers. And that's the best tool that you can give someone is an education in mortgage understanding, because it is one of the biggest purchase anyone is going to make. So without further ado, let's continue on and start with our first program that we're going to cover today. And again, don't be shy and put questions in there. So we're going to start with a very popular program that is called CalHFA Home Loans. I don't know if any of you have heard this before, but basically CalHFA is a government loan. It is, the funds are federal funds. This is a program that is either offered as an FHA program or as a conventional loan. And so what CalHFA does, it pretty much covers 100% of the purchase. So in other words, it can cover your down payment plus your closing costs. Or if you have the down payment, but you don't have enough money for the closing costs, it can cover the closing costs. So it can do either one or it can do both. So in a nutshell, it can cover 100% as long as you meet the criteria and you qualify. Now, this program is not a grant. So it's not a gift. It's not forgiven. You do have to pay it back. And we're going to go to the next slide and explain how it works. So this program, as I mentioned earlier, right, you can apply for CalHFA. So let's say you have some money and you want to put 3% down, which would be the bare minimum on any loan, whether it's a government loan or whether it's a conventional loan. The minimum is 3% if you go conventional. If you go FHA, it's 3.5%. I'll explain the difference on conventional versus FHA a little bit further down the line or at the end. So in the CalHFA program, again, whether you go FHA or conventional, if you say, I need help with the down payment. I have the money for the closing costs, but I need the 3% down payment. So what we will do is give you something that is called MyHome Second. That would be the down payment that we would give you. So for instance, we'll do some hypothetical number just so that you can get an estimate. Let's say you're buying a house that is $600,000. So 3% of 600,000 would be 18,000. So that would be the amount of money that you would get under the MyHome Second. Now, if you say, well, I don't have enough money for closing costs, I only have 10,000, let's just say, obviously all these numbers are hypothetical, but let's assume that your closing cost is, sometimes closing costs could be as high as the down payment, depending on the location, the property taxes, and other factors. So you could need probably 18,000, let's say, for closing costs and 18 for down payment. That's 36, right? But if you only have 10, that means you're going to get the remaining 26 from this program. So it would be a combination of a second and a third lien. Now, these loans, we also refer to them as silent seconds. Why do we call them silent seconds? Is because you're not required to make a payment every month. Basically, they stay dormant or in the sleep mode or in silent mode in your property as a recorded lien. Through the years, you are required to pay them off at some point. So let's say, 5-10 years down the road, you're in a better financial situation and you're able to refinance, then at that point, you would have to pay those loans off, plus whatever the added interest is. Typically, the added interest, it is a lot less than it would be on if you were to borrow that kind of money. So that's what you would do in that situation. Or if, let's say, 5-10 years down the road, you decide that you want to sell that house because now you have equity and you want to take that equity and purchase another property, then if you sell, then those loans will need to be paid off, and whatever your equity is, you take it and you use that money to purchase another property. Now, this program obviously only works for primary properties, first-time home buyers. And the amount of money you will receive also depends on the amount of money you make, the county. So there's a lot of little factors. So we're going to cover the basics, but always on any of these programs, a full application is typically required to determine the exact amount that you will receive. Okay, so we're going to move on to the next one. So who is eligible? I kind of mentioned this, right? First-time home buyers, low to moderate income households. So somebody that is making $1 million a year is probably not an eligible candidate, right? You have to meet the income criteria that I mentioned and credit, and it has to be a primary residence. So we covered this so far, right? Also, I think there was a question that another client had asked me before. So in this program, they had asked me whether they needed to be citizens on this program. And no, you don't have to be a citizen, but you would need to be a permanent resident, or you would, if you're not a permanent resident, you do need to have a visa. These programs are not eligible for individuals with tax ID numbers. You do need to have a social security number for this program. Okay. So now, and again, if you have questions, please put them in the chat and we'll answer it as we move along. Now, many qualify and don't know, right? So that's why, we say that in order to really determine your specific scenario, because it varies from everybody, right? Everybody's income's different. Everybody credit score, dependents, county, everything is different. Everybody is their own little world. So we need an actual application to determine the actual amount that the person would qualify for. So now we're going to move on to the next one. Now, the WISH program is a grant. So this is money that you do not have to pay back. So yay. And you do not get a 1099, because I want to also let you know that there are other programs out there sometimes that a credit union can create or something, and you will get a 1099. If you're not familiar with what a 1099 is basically a document that shows that you received X amount of dollars, and you have to declare that with your taxes at the end of the year, with your income taxes, and then that money, that gift is taxable. So it could potentially change your tax bracket. So it is recommended that you speak with your CPA or the tax person or whoever files your taxes, how a 1099 would impact you. So the good news is this program is not a 1099. So whatever you get from the WISH grant is pretty much free money. Now, the maximum amount of money that you can get in 2026 is up to $32,837. This amount changes every year. The same goes for the CalHFA. All those numbers and the amount of money people make, the size of the family, these amounts we're covering today, these numbers are good for 2026. So they're updated every year. Now it is up to $32,837. So in some cases, you may get less, because the way the program is on the grant, on the WISH grant, is they give you about $4 to every dollar that you contribute, because you are required to contribute at least 1% of your own funds. So if you put $7,500, then you'll get $30,000, and you can use that money for a combination of things, for the down payment or for the closing costs, or for both, right? Plus whatever you're contributing. And also, it is programs, if the seller is willing to help you with any funds, you can still use those funds in combination to the WISH grant, as long as we don't exceed the actual cost and the actual down payment. But whenever we have a situation where you're getting a large amount of money from a seller, we will discuss that with the buyer and the realtor, and we will make a strategy where we can utilize all of the money to your benefit, either to buy down the rate or either to put a larger down payment, either from the grant, and then use all the seller's concessions for the closing costs. So there's always a way to strategize and make it more favorable to the buyer. That's usually when Ralph and I look at things and we discuss it with the client. So obviously we always want to look in the best interest for the client to capitalize the most they can, so that it benefits them in a way of having a lower payment or a lower loan amount. So now let's move on. Now, the good thing with this program, like I mentioned earlier, is a grant. Now, you are required to live in the property at least for 5 years. So if for some reason you get the grant and then 3 years later you don't like the neighborhood, or in some cases, sadly, sometimes people divorce or they move jobs or something happens and they need to sell and not live on the property, then the loan will not be forgiven. So it is required that you stay in that house for 5 years as a owner occupied. And sometimes I had questions of clients. So how do I, they'll say, how do they know I don't live there? Well, it's very simple. We don't have, obviously, the police knocking the door and checking on people, whether they live there or not. But, people file taxes, your pay stubs, your bank statements, those things have your address, right? And that's legal documentation. So, it is required that you live in there for 5 years. Once the 5 years have passed, then the loan is forgiven, and it gave you help, right, to get into that house. Also, another question that I've had is sometimes people ask me, can I use this loan in the future? Yes, you can. You can use it again as long as you have not owned a house in the last 3 years. Okay. All right. So now let's move on to the next. And then again, who is eligible? All these programs are going to be very similar to the eligibility. And basically is first-time home buyers. You have to be within 80% of the AMI, FICO score 660 or higher, and contribute at least 1% of your own funds. And you also have to complete an 8-hour home buyer course. And
Can I ask a question?
Sure, of course.
What is AMI?
So AMI is pretty much the amount of money people make per county. That amount is determined by the federal government. And can I take 30 seconds? Because looks like my battery, for some reason, on my laptop is flashing and I don't want to go off the line. So let me just plug it in real quick. Ralph, you want to take over for like maybe 30 seconds?
Yeah. So I'm looking up while you're doing that. I'm looking online to see what AMI stands. It stands for Area Median Income.
Okay, I'll be right back. Sorry about this.
Okay.
It's never happened before.
Let me turn my camera back on here. Yeah, so AMI stands for Area Median Income. All right. Any other questions so far, you guys, that you may have? I have a question that I'm going to ask Roxana when she gets back. I'm interested to know, how do you know when the loan program is forgiven? Do you get a letter? Do you have to apply for it? But what, at the 5-year period, do you have to do something before you get the forgiveness notified, or do you just wait till you sell the house?
Great questions. And I'm back.
Okay.
I was worried. I'm like, oh my goodness, my apologies. So I'll answer both questions. So first, the AMI is the Area Median Income. So I wish we could bring a chart, but we didn't. I didn't plug it in. But basically, I'll give you an example. So Ralph and I are in the Inland Empire, which covers San Bernardino County, Riverside, and we're near LA. So for instance, in Riverside and San Bernardino counties, the maximum income that the government has determined that is $205,000. So they go 80% of that, right? So if you have somebody that makes 205 and 80% of that is about 164,000, right? So from there, they also use the size of the family. So there is like a formula, right, that we have
Mm.
in underwriting has, and we plug in your income and the size of the family. So I would say maybe a family of two, like a husband and wife, and they're making 164. Most likely they will be most likely eligible for a CalHFA, which is the
Okay.
loan, the one we covered previously, right? Now, if we have somebody with 164,000, let's say a family of four, most likely would be within the range of this program.
Okay.
And then keep in mind that those amounts can vary from county. It could also be impact the size of the family, right? Because what if somebody has three children, is husband and wife, and then only one of them works? So, and they make 164, then they're within range of the WISH program. So that's how that works. Okay. Now this 80% sometimes can change, right? It can go higher. So that means that you can make more income, right? So that's a good thing when they increase the AMI. There are programs that have higher AMI than the WISH program. Now, another thing about this program that you were asking is how do they know when it's forgiven? So it would be forgiven on the anniversary of the 5th year since the deed was recorded, right? So technically the date you close escrow, and the way you do receive a letter, right, from the servicing department, whoever has the loan, the company that has the loan, in this case, let's say Golden One, you would receive a letter within maybe 30 to 90 days from the time of the anniversary saying that your loan is now has been already forgiven, and you pretty much keep that letter because if you ever need to refinance or sell and that lien pops up, you want to make sure that you have your documentation in line. And then you probably will receive also something from the county saying that this lien was released, and you keep those for your records. If you don't receive anything, I would say you would contact your servicing company at that moment right away and call them, find out. But that's typically when it's forgiven.
Okay, thank you.
Okay. Also, this program, just like all the three programs we're going to cover today, again, is first-time home buyers, primary residence only. And also all of them require for you to take an 8-hour home buyer course. And it is important that you take that course because it actually enhances your knowledge and it helps you make very educated decisions. It goes more in detail about the AMI, about the to income ratios, which Ralph kind of touched on, because a lot of people say, what is DTI? You're going to hear a lot of acronyms like UCAMI, DTI, FICO, LTV, all those things you need to get familiarized because you need to understand what we're talking about. And also it will help you for you to ask better questions, because sometimes if you don't understand what you're getting into, you don't know what to ask, right? And so all these programs do require that home buyer course. You could do it in person, you could do it online, but it is required that you do it. Once you take that course, it is good for 1 year, and you can use it either for CalHFA, for the WISH program, or for the other one that we're going to cover in the next few slides. Okay. Any other questions so far?
Not so far.
Okay, so let's move on. So the program that we just covered, the WISH program, can also go with an FHA or a conventional loan. And in right here is where I want to kind of cover the difference between an FHA and a conventional loan, because I get this question quite a bit. People will say, well, what's the difference? Is one better than the other? And the answer is no. Both of the programs are great programs. The difference is which one is better for your situation, right? For instance, an FHA program is from the Federal Housing Agency. That's what FHA stands for. So it is a federal loan. The money, it comes from the federal department. And basically in this program, they're a little more lenient on the credit. So for instance, perhaps if we compare it to a conventional loan, the FICO score requirement may be higher than an FHA. FHA typically requires a minimum score of 620. But as I don't know if you notice, a lot of these programs require around 660. So although it could be an FHA, but if you decide to use a grant, then you might be required to have a higher FICO score. But FHA, as it is designed to be more lenient on the credit score. If you don't have a perfect credit, or if you don't have a large down payment, or there is there's some, let's say, inconsistencies with employment, or the income is too variable, or if you had a recent bankruptcy, FHA might be the only program that you're eligible for. So in those senses, FHA is a great program because it helps other buyers that could not buy under a conventional loan. It gives them that ability to purchase a house. Another thing with the FHA is it tends to have a better rate, a lower rate than a conventional loan. However, FHA sometimes could be a little bit more costly because it's a federal government, it's a federal agency loan or a government loan. Basically, it has a cost that is called a funding fee or a mortgage insurance that is typically a little higher than a conventional loan. For instance, on an FHA loan, when you purchase, when you use this program, 1.5% of whatever the purchase price is, or the loan amount, will be added to the closing cost. So if we use the same scenario that we used earlier, and let's say you purchase a house that is $600,000 and you finance 582, which is 97% loan to value, that means that you would have to add about $8,730 funding fee to the FHA cost. So on top of your cost, you have this addition of $8,730, and that money goes to FHA. And pretty much they use that money so they can keep lending to other people. Now, also the mortgage insurance on the FHA loans stay there for the life of the loan. You cannot remove it even if you have enough equity in the future. So the only way to get rid of the mortgage insurance on an FHA loan would be to do a full refinance. And I know we're going over a little bit more in our time, so I'll try to accelerate this a little bit more. So that's in a nutshell what an FHA is. Now, a conventional loan is not a government loan. It is either Fannie Mae or Freddie Mac, which are somewhat government agencies, but actually they only buy back loans. So conventional loans are either private investors, banks, or credit unions. And so typically they have a higher requirement on the FICO score, but you can get rid of the mortgage insurance within 2 years or once you have enough equity, and there's no 1.5% funding fee added to it. So it's less costly. So there's always pros and cons with both programs. So the best way to determine which one's better for you is talk to your loan officer, have them explain based on your situation which one would be better. Okay. So now let's move on. In our last program that we're covering is called the Middle Income Down Payment Assistance. So this one is the one that it gives you up to $50,000. Now, this program is amazing. It does not give you a 1099 at the end of the year. You don't have to pay it back. I believe you do have to live in the property for at least a year. And then the income requirement on this one is not as strict as in the WISH program. The only little bit of a setback on this program is it only gives us about 11 million, which sounds like a lot of money, but it's not when it comes to mortgages. So we get about 11 million a year on this program, and it is first come, first serve. Whenever the funds are released, they typically go pretty fast. So we always recommend that you should be already pre-approved, should already be looking at houses, should already be putting offers, because the moment the program rolls, in order to secure those funds, we need an actual purchase agreement. And then once we know that you have an accepted offer and you give us the purchase agreement, we immediately send the request to hold your funds. Once we know that the funds are secure, we notify you within 2-3 days the funds are secure. Then you have up to a whole year to pretty much finalize the purchase. But obviously you don't want to wait that long, because if you cancel that purchase, then that money, we lose the security and it goes back basically to whoever is in the waiting list that is waiting for those funds. So the idea is that you close obviously within 30 to 45 days maximum. Typically when they release these funds, they're at the beginning of the year. They usually come out around March, and I would say by the end of March is almost gone. And the way they do it, the funds come from the Bank of San Francisco, which is not a direct bank where you can go and apply for a loan, because they don't do that. They deal only with the approved lenders, and Golden One is one of them. And typically they release the majority of the funds in March, which is about 9 million. But they do leave the rest of the other 3 million, which is, again, is 3 million is not a lot when we think it is a lot if somebody gives us 3 million, right? But it's not a lot when it's lending money. So basically those 3 millions will probably be released towards the fall. So I would say September, October. So if you're in the shopping arena at that time, and we have reviewed your loan for a potential middle market down payment, then we will secure the funds. But again, it's first come, first serve. So, there's always pros and cons with first come, first serve, because there's no guarantee that you're going to get the 50, but it is available. And then the ideal would be to start at the beginning of the year and be ready. So that's how this program works. And then you do have to contribute at least 10,000 out of your own funds for you to get the maximum. Okay. Now, the funds that you contribute could come from a savings, gifted funds, or even the seller, or both. Okay. And there's no repayment. It's a grant. It's not a loan. And again, first time home buyer. You see how this one went from 80 to, it says right here, income 80 to 140, but actually this one is ranging around 140 AMI, which means that you can make a lot more money and be eligible for this program. They do require for you to have at least a 660. And on this one, you do have to contribute money out of your own funds, at least 10,000, and complete the same course that we mentioned earlier. And again, you have to be a citizen, a resident, or if you're not a resident, you do have to have a visa and a social. And I think I covered this, that you have to have open escrow and close at least within a year to secure the money. And then the second round comes up during fall this year. So get ready, because 3 million is not a lot. So that probably will fly out in one day or hours. And that's all I have so far. And there's always so much more information. And so I also want to take the time to thank Ralph. Oh my God, he is so good at this. And thank you for inviting me. And I love that you go and reach out to the community. You educate them about all these programs so that when they're ready to buy, at least they have all the tools, all the knowledge, and they can say, okay, I'm gonna go this way or that way. So thank you, Ralph, for putting this together for the clients that are online.
Well, thank you, Roxana, for the presentation and for the information. I learned something today. I didn't realize that the grant programs that you are sharing with us do not require 1099.
No,
And
they do
so
not.
I have offered other grant programs to my clients that do require that 1099. That is a big deal for clients. So that's something new that I've learned today about your program. So I appreciate that. I can share that with my
You're
clients
welcome.
now. Um,
You're very
let's see.
welcome.
Any more questions in the chat? Oh, Travicia is saying thank you. This was very helpful. And, we want to thank you for being here today and for asking questions and participating in our webinar. We hope you'll take a moment to check out the futurehomeownerplan.com as well. And, any closing comments that you have, Roxana?
And no, I pretty much want to thank our clients that are online because I know, especially Travisha mentioned the toddlers. So I know how it is having children and trying to be on the phone or trying to be online. And also Christopher, where sometimes we could be just chilling in the couch or maybe just relaxing or working. But you guys took the time to learn, and I appreciate that. Time is very valuable, and we sincerely appreciate you being here.
All right. And I know we had a few people that couldn't make it today that wanted to watch the replay. So if you're watching this after the presentation has concluded and you're watching the replay, we want to thank you for participating and watching this video back too. All right. So that will conclude our webinar. Once again, thanks everyone for being here today, and we'll see you on the next one.
Golden one. Bye, everyone.
All right. Bye-bye.